Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about interest rates and inflation. They're two topics that have really been dominating the financial press over the last couple of weeks. And certainly bond markets have been pricing in higher inflation, which is kind of interesting. So the markets are thinking interest rates will rise a little bit sooner than what the RBA has indicated. But it's my view that inflation is temporarily high and the markets have got it wrong. And we should remind ourselves that sometimes the markets do get it wrong and popular opinion isn't always right. In fact, the bond market had a go at sort of predicting higher inflation in February this year, realised it got it wrong and the market corrected after a few months. And it seems like this is kind of to some extent happening again. So before I get into it and sort of share my rationale, let's have a quick economics lesson before we do that. So inflation is really just a measure of rising costs for goods and services. And it's measured by the Australian Bureau of Statistics. And they use a basket of goods and services, the same goods and services, and it's really supposed to be reflective of what generally Australians are spending on. And high inflation is typically really bad for an economy because it erodes your purchasing power. It increases uncertainty within the economy, and it can have some negative impacts on the country's currency as well, which obviously impacts imports and exports. So generally, countries would like to see inflation at manageable levels. And that's one of the roles of the Reserve Bank of Australia, is to manage inflation inside its target band of 2 to 3% per annum. So that's where it wants to see inflation sustainably. And it does that by changing interest rates, so the cash rate, the RBA cash rate. And obviously, if you increase interest rates, it takes money out of consumers' pockets and also business and the government sector as well. And so spending declines because obviously your interest bill is higher and therefore loosens off demand for goods and services, and therefore we should see then prices contract. And that's the way. So low interest rates will be very stimulatory and hopefully encourage people to spend more. Higher interest rates will work in the reverse order. Now, bond markets give us an idea about what the market thinks where interest rates are going, because what happens is they'll trade the yield curve up, which means that interest rates in 3 years, 5 years, 10 years start to rise. And that sends a message to the market that, that generally people are thinking interest rates are on the rise at some point, but also it can have an impact on existing bonds, particularly if that bond has a fixed coupon or fixed interest rate. And it's a relatively low interest rate and people think interest rates are rising, then the value of that bond will fall because it's less attractive, right? Because it's got a low interest rate. And that's what's been happening in the bond market really since August. Is that yield curves have been bidded upwards and it's put pressure on the pool of existing bonds. So let's have a look at inflation. The inflation was released by the Australian Bureau of Statistics last week. It came in at 3% for the year ended September 2021. Which is obviously certainly at the top end of the RBA's band. So if you just look at that headline rate, you'd say, okay, we've got some concerns about where inflation is going. Ironically, it was less than expected. The market was expecting 3.1%, and the reading last quarter was 3.8%, so it's a little bit lower than that. So what I wanted to do is have a look at what's happened over the last year to cause higher inflation. Because in September 2020, the inflation rate was around about 1%, or just less than 1%, in fact. And so now, a year later, it's 3%. And really, there's 5 categories of goods and services that have contributed to that rise. And these categories have risen by more than 2% over the past year. And they are transport, furnishings, health, alcohol and tobacco, that's one category, and then recreation. So if we have a look at sort of each of those categories in turn, well, transport's risen by the most, and that's not surprising because this time last year, oil was trading at $40 a barrel, which was ridiculously low. Obviously, the world was locked down at that stage. No one was travelling, so demand for oil was very low, and the price reflected that. At the moment, it's currently trading at low 80s, $80 a barrel. So the price of oil has doubled, and of course, that's had a contributory effect to the Australia's inflation rate. The next category is furnishings. So cost of furnishing has been elevated. So that's furniture, of course, for two things. Firstly, unusually high demand. People in lockdown have been upgrading their furniture, obviously, and then disruption to supply chain. So, people are willing to pay more to get the furniture now rather than wait a few months. Alcohol and tobacco was really driven, that sector was really driven by tobacco, and that's really mainly due to an increase in government excise and customs duty last year. And then health, the main driver in health was health insurance premiums. Anyone that has health insurance knows that they increase every year, which is nice. And recreation and culture, which is the last category, mainly driven by domestic travel and accommodation. Obviously, given the international borders have been closed, the only way Australians can holiday is domestically. So it's not surprising to see price increases in that category. So if you have a look at that, really, are those factors going to repeat themselves? How much furniture do you need to buy? Oil's almost certainly not going to double over the next year. There's probably not going to be any excise increases in tobacco. Health insurance premiums will continue to rise. I'm sure that's true. And now that international borders are opening, maybe that'll take a little bit of pressure off the recreation and travel. And really, there's a number of factors that have contributed to all these price increases, and most of them are temporary. In fact, almost all of them are temporary. And so therefore, when we make a decision around that inflation reading, the RBA really needs to think, is it temporary or is it sort of permanent? Or repeatable, and therefore, because that's what the RBA will then consider when deciding whether to increase interest rates. And it's also been well documented. There's other sort of sectors of the market. Used cars are higher, in terms of prices and so forth. And there's lots of little stories, I guess, going around. And there's a few reasons for that, and really three I can think of. That will have an impact on either temporary or permanent on the inflation rate. The first one is supply chain disruptions, and the price of shipping has been well documented. It's through the roof. It's 3 times, 4 times higher than what it usually is, caused by a few different things. Obviously, an unusual demand for goods, stevedoring strikes, container shortages, truck shortages. They can't get the containers off out of the port and so forth. All these things aren't really insurmountable. I mean, they're going to be relatively easy to solve. I think it'll just take a little bit of time to solve them. The second thing is unusually high demand for durable goods, and that's really globally, but particularly in the US. So that could include things like cars, furniture, household goods, those sorts of things. Spending has been abnormally high. Well, it's probably entirely possible, or I would say likely, that whilst spending on durable goods has been unusually high during the pandemic, it's probably going to have a couple of years where it's going to be unusually low as well once things open up and spending patterns return relatively to normal. I think that'll take the pressures off those categories. And lastly, savings. Because we've all been locked up for an extended period of time, particularly in Melbourne, Australians have been saving more. And since March 2020, when the pandemic began, Australian deposits at banks, of course, have increased by $140 billion, which is almost twice the amount that's usual. So really there's 70 billion of extra savings that at some point might be pumped back into the economy, and obviously that's going to probably create some inflationary pressures in some sectors of the market also. Now, for all the commentators that suggest that inflation is too high and the RBA should make some movements in terms of interest rates, the most compelling factor that I consider are incomes. It's very difficult to see how an economy can have sustainably high prices if they don't also have higher incomes, because if my income's not increasing as a consumer, how can I afford to keep paying higher and higher prices? It's just not possible. And the wage inflation index is well below 2%. And that's really what the RBA is saying, is we really want to see some wage inflation, some rising incomes, because that's when we know that the underlying inflation will continue to rise. And it's a good opportunity, I think, in this low-rate environment to try and stimulate the labour market to get some increase or rising incomes, particularly for Australians and particularly for lower income earners that have been impacted to a much greater extent through COVID. The RBA's wage growth index is, as I said, well below 2%, and it's not even looked like it's moving. So hard to really see how longer-term inflation can remain at elevated levels. I was most surprised to read a piece in the Australian Financial Review over the weekend by a bond trader called Chris Joy. And he forecasted that a 1% increase in interest rates would lead to a 15 to 25% fall in property prices. So, of course, I was very surprised to read that. And I've followed Chris for many years and always found his commentary to be very insightful. And a lot of his forecasts tend to be very, very accurate. So, of course, it really grabbed my attention when I read it. However, on this occasion, I couldn't be less agreeable to his forecast. And interestingly enough, as I riffed about last week in this podcast, how it seems like every year there's a high-profile commentator that predicts a property market crash, and maybe it's Chris's turn. It was just ironic that I had mentioned that the week before. But what I did is I had a look at household debts and had a look at their interest bill at the moment, and then worked out what the household interest bill would be if interest rates rose by 1% and then 2%. And what that will tell us is how sensitive are Australian households to interest rate increases. Could a 1% rise really have a material impact on household budgets and potentially really cool the property market? Well, you'll see a link to the chart in the show notes, and of course there's the charts on the website. But you can see very clearly that a 1% increase would be very affordable, and a 2%, certainly might put pressure on budgets, but 1% is very affordable. And there's a few other things to consider when starting to read predictions like that. And normally I wouldn't give it much credence, but as I said, Chris Joy tends to be he's right a lot more than he is wrong anyway, which is rare for forecasters. The first comment I would say is that any new borrowers have had their affordability tested at around 5.5%. I mean, if you go to a bank and apply for a new loan, they're going to make sure that you're not going to be under pressure if interest rates rise by 1 or 2%. In fact, that you can afford it when interest rates, or if interest rates are 3 or more % higher than what they are today. The second observation I have with respect to the property market is that most of the activity through the last year has been for owner-occupiers, not investors. And that's important because owner-occupiers aren't trying to speculate on a market. They're making a lifestyle decision, which tends to be a bit more robust. And so owner-occupiers will do everything possible before they'll sell their home. So they'll reduce expenditure, discretionary expenditure, whatever. Whereas investors a little bit more speculative and easier for them to exit the market because it's not their home. They can just go and sell the investment property. And lastly, credit is still very tight. So anyone that's borrowed over the last 5 years almost certainly will not experience any difficulties if interest rates rise by 1%, unless their situation has changed, of course. So I really don't give a lot of credence to Chris Joy's forecast. I think the property market will be fine and will continue to perform well. And I think it's important to remind ourselves of the context of the most recent rises in the property market. If you have a look at average growth over the last 5 to 10 years, it's been below the long-term average. Over the last 5 years, Melbourne's median house price has increased by just shy of 7%, Sydney by about 6.5%, and Brisbane by under 5%. Now, that's the median house price to June 2021. Of course, there's areas and markets and types of properties that have increased by a lot more than that. But when we get concerned really about property prices, it really should be reflected in the median house price rather than just anecdotal evidence, because, that there hasn't been a lot of properties really for sale over the last 12 months, particularly in markets in New South Wales and in Sydney, I should say, and Melbourne. So what will happen to interest rates then? And I think that's probably the million-dollar question. Well, I don't think the RBA is going to increase interest rates because they're worried about inflation, because interest rates aren't really going to help all the factors that have driven the inflation higher. It's not really off the back solely of increased demand from consumers. So raising interest rates isn't going to help in that area. Of course, interest rates are really low at the moment. That's stating the obvious. They're really in expansionary settings, and they will need to be pulled back into line at some point to a sort of neutral setting. And we don't really know. I mean, it's going to be really interesting to see what that neutral setting is. I think it's lower than what it used to be, at least pre-pandemic, mainly because, or at least 5 years ago even, mainly because of the increase in debt. Anecdotally, I think the neutral level, so that's an interest rate level where it's not stimulating the economy or contracting the economy, will be somewhere in the range of 4 to 5%, I think. So we need to get back to that level at some point. We can't create an addiction to low interest rates, but I don't think we're going to see that for some time, maybe not until the end of 2023 or 2024, which is what the RBA has said. Of course, they're going to keep a really close eye on wage inflation. There are two really other important observations that I should point out. The first one is that government debt is very, very high, and I'm sure the government will be most interested in keeping a lid on interest rates, particularly as the federal government approaches $1 trillion of debt. And a rise in interest rates is not going to serve their budget deficit very well. And as a politically sensitive issue, I think there'll be some pressure from politicians there. And so, although, of course, the RBA is independent, wink, wink. And secondly, lower income earners. Lower income earners have been impacted to a much greater extent through the pandemic than higher income earners. In fact, on the whole, higher income earners are in a better financial position now than pre-pandemic. That's not true for lower income earners. So if we increase interest rates, the impact, it's least affordable by lower income earners, and they've already had to sort of weather that storm. So interest rates, a bit of a blunt instrument. It can impact some people adversely that you don't hope or plan to, but I think it'll be on the RBA's mind. So I don't think interest rates will change next year, 2022. Probably sometime in 2023, but I think they'll be relatively cautious. I don't think they're going to tick up by a huge margin, 1 to 2%, I would imagine, over a period of months. But of course, as we've been taught over the last 18 months, anything can change, and it can change very quickly. Okay, so that's it for me for today. Until next week, bye for now.